Welcome, everyone. I'm Dick Berner. It's my pleasure to welcome you to today's webinar, which is sponsored jointly by the NYU Stern Center for Global Economy and Business, directed by my colleague, Venki Venkatswaran, and the Volatility Risk Institute, which Robert Engel and I co-direct. Before I introduce our speaker, let me say a few words about the plan for today's program. Following Ms. Logan's remarks, we invite you to submit questions in the Q&A together with your name. We do not accept anonymous questions, and the program will end at 5:30 p.m. So now for a brief introduction of our very distinguished guests. We're very honored and delighted to welcome our speaker, Lorie Logan, Executive Vice President at the Federal Reserve Bank of New York and manager of the System Open Market Account, which executes monetary policy at the direction of the Federal Open Market Committee. Our topic today is Fed asset purchases, the pandemic response, and considerations ahead. And Lorie, thanks so much for being here, and the floor is yours.
Thanks very much for the introduction, and I'd like to just start by thanking you and Venki for organizing today's event. As Dick would likely recall, I was supposed to give a talk about implementing policy here at NYU Stern 2 years ago, almost to the day, but we had to cancel that speech as it became clear that the emerging pandemic and the efforts to contain it would disrupt the global economy and lead to unprecedented strains in financial markets. Today, the world faces an extraordinary new challenge. So before I begin my remarks, I'd like to acknowledge the distressing events in Ukraine and the terrible hardship that this places on the Ukrainian people. The economic and financial impact of these events will certainly take time to become clear, but on the desk here at the New York Fed, we are monitoring global developments carefully. So my remarks today will begin by looking back at the pandemic crisis and the historic policy response. Starting in March 2020, the Federal Reserve took a set of extraordinary measures in response to the economic stresses and dislocations in the global financial system triggered by the pandemic. And these actions, which were taken in close coordination with the US Treasury and alongside a forceful fiscal response, were successful in supporting the functioning of financial markets and maintaining the flow of credit. And they were critical in providing accommodation to the US economy during a very vulnerable and uncertain period. Now, in light of recent strength in the labor market and elevated inflation, the FOMC has decided to end net purchases of Treasuries and agency MBS early this month. The committee also stated that it expects it will soon be appropriate to raise the target range for the Fed funds rate. And it released principles for significantly reducing the size of the Fed's balance sheet. With net asset purchases coming to an end, I think it's an opportune time to share a few reflections. So today, I'll first review the asset purchases that we conducted over the past 2 years, exploring how the committee's evolving objectives for these purchases influenced the desk's implementation approach. And second, I'll highlight how these purchases shape the SOMA portfolio and discuss some considerations ahead for policy implementation in the context of the FOMC's recently issued principles for reducing the size of the balance sheet. So I'll start with the Fed's asset purchases, both the objectives and implementation. Next week, as I said, the FOMC's net purchases of Treasury securities and agency MBS will come to an end, marking the conclusion of this historic program, with net purchases having totaled about $4.6 trillion, as shown here in Figure 1. The purchases were instrumental in supporting the flow of credit to the US economy and fostering accommodative financial conditions. And along with other significant policy measures, it prevented a much deeper economic downturn. The onset of the pandemic resulted in an unprecedented dash for cash, as heightened uncertainty in the outlook and shifts to a remote trading posture prompted extraordinary price volatility, sudden portfolio de-risking, and strains in market functioning. And in this environment, even the most liquid securities like treasuries were being sold broadly and in large quantities, overwhelming the market's intermediation capacity. By mid-March 2020, Treasury and agency MBS market functioning had declined to levels not seen since the global financial crisis. In this extraordinary environment, the Fed stepped in to buy securities at an unprecedented scale and speed to restore market functioning and maintain the flow of credit. And this entailed purchasing record amounts of securities to address one-way selling flows and to meet the immediate demand for liquidity. The flow of these purchases helped to alleviate private sector balance sheet constraints and meet this demand for market liquidity. And over time, purchases restored two-way trading and more normal market functioning. The FOMC's full commitment to purchases of these securities and the amounts needed to support smooth market functioning also had the effect of stabilizing precautionary sales and forestalling a spiral in liquidity demand. So during this period, flexibility was a hallmark of our implementation approach. We adjusted purchases in response to shifting market conditions, and we sized the purchases to address the immediate dysfunction. We closely monitored and assessed market functioning metrics, and we targeted sectors in which conditions were especially strained. In the MBS market, operational adjustments included purchasing a broad range of securities that came under intense selling pressure and purchasing for near-term settlement, which helped ease pressures on dealer balance sheets. And this differed from our typical practices of purchasing recently produced coupons in the TBA market for forward settlement. So given the depth of the strains, market functioning improved only gradually at first. However, when the committee's full commitment to supporting market functioning and the desk's continuous operational adjustments, market functioning metrics improved considerably over the course of several weeks. And then we reduced purchase amounts commensurately. And you can see this in figure 2. In the Treasury market, bid-ask spreads narrowed and market depth rebounded. And additionally, as shown in figure 3, agency MBS market liquidity conditions, as represented by the effective bid-ask spreads, also improved markedly. As market functioning improved and conditions stabilized, the committee shifted its focus to fostering accommodative financial conditions to support the economy as it recovered from the pandemic shock and to sustaining these gains that we've made in market functioning. Now, while asset purchases conducted to support market functioning were used to address the severe and acute stresses, asset purchases aimed at fostering accommodative financial conditions are a standard part of the committee's monetary policy toolkit, employed when the federal funds rate is constrained by the effective lower bound. So by reducing the stock of securities and duration risk held by private investors, Fed asset purchases lower term premiums and longer term interest rates, easing financial conditions broadly. In addition, purchases of agency MBS reduced the amount of prepayment risk held by investors, leading MBS spreads to fall and resulting in lower mortgage interest rates for homeowners. Asset purchases can also convey information about the FOMC's policy intentions, as market participants believe the committee would be unlikely to raise its policy rate while conducting asset purchases. As the FOMC's objectives for asset purchases evolved, so too did the operational approach we took to those purchases on the desk. The purchase amounts were quickly scaled back as conditions improved, as shown in figure 4. We can see here that daily average purchases dropped over 100 billion in late March to nearly 10 billion by the summer. And without the need for high frequency adjustments to address market strains, we extended the horizon for purchase calendars to provide more predictability in the planned operations. And purchase allocations also became standard and were distributed relatively neutrally to the universe of the securities outstanding. So in this case, Treasury purchases were allocated proportionally to the amounts outstanding across the nominal Treasury coupon and TIPS curves. And in the MBS market, the composition of purchases was adjusted to be roughly in line with recently produced coupons in the TBA market. So overall, the asset purchases and the operational approach that we used to implement them were effective at achieving the committee's objectives. The flow of purchases substantially improved market functioning by meeting immediate demands for market liquidity in strained conditions. And the overall stock of Fed asset holdings resulting from both purchases initiated to address market functioning and those conducted with a focus on providing accommodation work to put downward pressure on longer-term yields and ease financial conditions. And the committee's communications about asset purchases had important signaling effects about its commitment to supporting the economy. So what I take away from this experience is that the FOMC's toolkit for addressing both severe market functioning disruptions and economic downturns is comprehensive and effective. Nonetheless, while asset purchases used to support market functioning and those employed to foster accommodative financial conditions may be broadly similar in nature, I don't view them as equal parts of the monetary policy toolkit. I expect circumstances warranting sizable intervention to support market functioning to be extraordinarily rare. And in contrast, the committee has indicated that asset purchases are a standard tool to provide accommodation when the Fed funds rate is constrained by the ELB. So 2 years later, what are the considerations for policy implementation ahead? Well, looking ahead with a strong labor market and elevated inflation, the FOMC has stated that it expects it will soon be appropriate to raise its target range for the Fed funds rate and has indicated that it intends to significantly reduce the size of its balance sheet. Now, for now, the FOMC has directed us to continue to reinvest all principal payments from the Fed's Treasury and agency MBS holdings following the conclusion of net purchases, which will maintain the size and broad composition of the portfolio. However, in recent meetings, the FOMC did begin deliberations on its approach to reducing the balance sheet. And following its January meeting, the committee issued principles to provide information on its planned approach. And these principles are high-level tenets. They're not specific plans. They build on the experience that we gained from reducing monetary policy accommodation over 2014 to 2019. And importantly, they also reflect the committee's assessment of the current environment. These principles start by affirming that the FOMC sees changes in the target range for the Fed funds rate as its primary means for adjusting the stance of monetary policy, and that reducing the balance sheet will occur over the process of raising the target range has begun. And the principles further state that when the committee decides to begin reducing its securities holdings, it intends to do so over time in a predictable manner, primarily through adjustments to reinvestments so that securities holdings decline with principal payments. In addition, the principles affirm the FOMC's choice of an ample reserves operating regime and an intention in the longer run to hold primarily Treasury securities. So in the context of these principles and the current contours of the SOMA portfolio from asset purchases, I thought I'd touch on a couple of considerations for policy implementation. And the first relates to the contours of the SOMA portfolio. The SOMA portfolio is substantially larger than it was at the end of the last round of large-scale asset purchases. And this reflects the extraordinary pandemic shock and the purchases needed to support market functioning and the economic recovery. And as shown here in Figure 5, at about $8.5 trillion and 35% of nominal GDP, the SOMA portfolio is roughly double the size in dollar terms and about 10 percentage points higher as a share of GDP than in late 2014. So given this large size, the committee has suggested that a significant reduction in the balance sheet would likely be appropriate. And this assessment reflects the view that with the overall elevated size of the balance sheet, SOMA securities holdings have more room to decline than during the prior period of runoff before reaching levels consistent with efficient and effective implementation in the ample reserves regime. So in addition to the much larger size of the SOMA, the weighted average maturity of Treasury holdings is about 2 years shorter than in late 2014. And this is because asset purchases over the past 2 years have been conducted across the Treasury curve, whereas the purchases under previous large-scale asset purchase programs and the maturity extension program targeted longer-dated Treasuries, and in the MEP sold shorter-dated securities. As shown in Figure 6A, the Treasury portfolio will have sizable principal payments from Treasury holdings over the next few years, ranging from 40 billion to 150 billion per month and averaging around 80 billion. And these could be rolled over or they could be allowed to mature depending on the committee's decisions. Now, for perspective, during the prior period of balance sheet reduction, which I show here in Figure 6B, the committee directed the desk to phase in a cap for monthly Treasury redemptions of $30 billion per month to limit the pace and the variability of the redemption amounts, particularly as you can see around the middle month of each quarter when maturities are greater. And I just observed that often principal payments were below the caps, and the average pace of Treasury redemptions was less than $20 billion per month. So agency MBS principal payments shown in Figure 7A are also expected to be modestly larger than those experienced during the prior runoff period and could average nearly $25 billion per month over the next few years. However, there is considerable uncertainty around mortgage prepayments. A downward shift in mortgage interest rates could increase prepayments substantially. And I showed that here, that uncertainty by the gray bars. So during the prior reduction period, which I show in Figure 7B, the committee phased in a monthly redemption cap of $20 billion for MBS. And this made the decrease in agency MBS holdings more predictable. And it also limited the possibility of pro-cyclical reductions in SOMA holdings during periods when interest rates fell in response to a worsening economic outlook. And in 2019, you can see that as the committee eased policy, this cap did limit the pace of agency MBS redemptions. So in summary, Treasury principal payments in coming years will be much larger and more variable than they were following the previous large-scale asset purchase programs. MBS principal payments will likely be modestly larger and are subject to considerable uncertainty. The FOMC has not decided on its plans for reducing the size of the balance sheet. However, the minutes from the December FOMC meeting noted that many committee participants judged that monthly caps on redemption amounts could help ensure that the pace of reduction in the SOMA portfolio would be predictable over time. So a second observation is that the committee's affirmation of its ample reserves operating framework provides broad insight into the longer run supply of reserves, a key determinant of the longer run size of the balance sheet. So during the prior period of balance sheet reduction, after the large scale asset purchases, the committee had not yet decided on its operating framework. And even after the committee announced the ample reserves regime, heightened uncertainty existed about the underlying demand for reserves, given the substantial changes in banks' liquidity management practices that had taken place since the global financial crisis. So today, the operating framework is well established. And importantly, we can draw on the prior experience with balance sheet reduction in assessing the demand for reserves. Now, that said, the underlying demand for reserves is still uncertain and it varies over time. Most large reserve holders assess their need for reserve balances based on intraday payment flows and projected outflows under stressed market conditions. And each bank has a different profile based on the composition of its liabilities and the outflow assumptions it makes. Moreover, the supply of reserves needed to maintain ample conditions, it's not just the sum of individual banks' demand, and that's due to frictions that limit the rapid redistribution of reserves. So as the committee reduces the balance sheet, we'll be carefully monitoring developments in money markets to understand changes in reserve conditions and to inform the committee's assessment of the appropriate path for the balance sheet in the longer run. And importantly, the prior experience with balance sheet reduction offers a useful guide to money market conditions that reflect ample reserves. The FOMC is committed to maintaining an ample supply of reserves to ensure that the administered rates, the interest on reserve balances, and the overnight reverse repo facility rate exercise control over the Fed funds rate. Now, should pressures in overnight markets unexpectedly emerge, the new standing repo facility that the committee established last year is also available, providing an important backstop to support effective policy implementation and smooth market functioning. And the third observation I wanted to highlight today is on implementation and flexibility. So as the committee turns toward reducing the high level of accommodation providing during the pandemic, the desk will focus on implementing the committee's plans as they develop. Overall, the FOMC's principles provide helpful guidance on the approach to reducing the balance sheet. Similar principles communicated in advance of decisions or actions during the prior episode enhanced understanding of the committee's approach, and I think that supported effective policy implementation. And this time around, FOMC participants generally noted that current conditions likely warrant a faster pace of balance sheet runoff than during the previous period. Given the experience implementing the last balance sheet reduction, it seems likely that redemptions can proceed smoothly at a somewhat faster pace than before. However, a significant reduction in SOMA holdings will require meaningful adjustments to private sector balance sheets as investors absorb the net increase in Treasury and agency MBS issuance and money markets transition to lower levels of liquidity. And these adjustments, they could take time. And while the Fed has some experience shrinking its balance sheet, the process is still relatively novel. So we'll continue to monitor markets closely to inform the FOMC's policy deliberations. And the committee is prepared to adjust its approach to reducing the size of balance sheet should economic and financial developments warrant. So finally, as the principles note, the FOMC will first increase the target range for the Fed funds rate before it begins reducing the size of the balance sheet. And at its January meeting, the committee stated that it expects it will soon be appropriate to increase the target range. So I'm also focused on liftoff and adjustments in money markets that might occur. So let me offer some concluding thoughts on this theme. The committee last lifted the target range off of the zero lower bound in 2015. And at that time, the Fed had no experience lifting short-term interest rates in an environment with abundant reserves. And there was significant uncertainty about the dynamics we'd see in money markets. Ultimately, the policy implementation framework, including the administered rates and associated operations, was successful in managing the Fed funds rate within the target range and lifting the constellation of overnight rates. And as we've seen over the past several years, the framework has continued to support effective policy implementation across a whole range of environments. So even as the current environment is characterized by higher levels of liquidity than we had in 2015, I'm confident that administered rates will again be effective at lifting the Fed funds rate when the committee increases the target range. The administered rates create strong incentives in overnight markets, and the overnight RRP provides a broad range of money market investors and alternative investment to support the Fed funds rate and other overnight rates. And my sense is that the current setting of administered rates relative to the target range has been working well, and that it can continue to support effective policy implementation following any increase in the target range in coming months, although adjustments could be warranted over a longer time period. With the high levels of liquidity in money markets, take up at the overnight RRP facility could increase as rates rise. Flows between bank reserves and overnight RRP balances depend in part on relative levels of interest rates on bank deposits versus other money market investments, such as money market mutual funds. So some banks may use rising rates as an opportunity to reduce reserve holdings by shedding deposits. So if when the FOMC increases the target range, banks raise deposit rates by less than money funds increase net yields to investors, funds could flow from banks into money funds, which could in turn increase the take-up in the overnight RRP facility. That said, while many expected an increase in the overnight RRP in 2015, this did not come to pass. And it could be that overnight RRP balances remain relatively steady following liftoff or even decline some. Regardless of what happens following liftoff, over time, as the committee reduces the size of the balance sheet, I expect usage in the overnight RRP facility to gradually decline. So in sum, the administered rates working together should maintain the Fed funds rate within the FOMC's target range. And I'm confident our tools will promote smooth implementation of the committee's policy stance. But as always, we'll be monitoring conditions closely and consider adjustments to our approach as appropriate. Thanks very much. I look forward to the questions and the conversation to follow.
Thanks very much, Lorie. That was, as usual from you, clear, comprehensive, and understandable and very informative. So thanks very much for that.
Thanks, Dick.
I've got a few questions reflecting my prerogative as moderator before we turn to questions from the audience. And at the start, you mentioned developments in Russia and Ukraine, and our hearts, of course, go out to the people of Ukraine in the current circumstances. Turning to financial markets, what's your assessment of the financial market reaction to the developments from the Russian invasion of Ukraine? And how do you think they might complicate the environment for the removal of policy accommodation?
Well, thanks, Dick. And our hearts do go out to the Ukrainian people. You know, I do think the economic and financial implications of the attack on Ukraine will take time to become clear. You know, on the desk, we've been closely monitoring recent developments and have been in regular contact with market participants, our central bank colleagues around the globe, and policymakers about what we're seeing and about our assessment of market conditions based on a wide range of data and market intelligence that we've been gathering. I mean, we've certainly seen recent developments lead to notable volatility and declines in market liquidity, but so far, outside of Russian markets, where the sanctions were certainly intended to have effects, our sense is that broader markets have been functioning in an orderly way. You know, I thought I'd, maybe focus a few remarks on dollar funding markets, which is a key point of focus for us with respect to policy implementation. And we're paying particularly close attention to conditions here. And I really want to make 2 points. The first is that there is significant liquidity in the financial system that comes from the growth in the balance sheet from the asset purchases conducted over the past 2 years. You know, I think liquidity in the system has supported financial stability given the shock from the Russian invasion and the coordinated sanctions that have been applied in response. And then the second point I'd highlight is that our policy implementation framework, has evolved quite a bit relative to where it was pre-pandemic. Importantly, the committee established 2 new standing facilities last year. The standing repo facility, I talked a little bit about that today, as well as the FEMA repo facility, which is for foreign and international accounts that hold their securities here with us in custody. And both of these facilities support effective policy implementation and smooth market function. And I think my sense is that their presence has also provided confidence in available liquidity, and that knowing these are operationally there and standing, I think that's mitigated some of the precautionary demand for liquidity that might have emerged amid the heightened uncertainty in an event like we've seen in recent days. And here I would note that the framework also includes the standing swap lines with our foreign central bank counterparts, and of course the discount window, which are both set at lower spreads relative to interest on reserve balances than they were pre-pandemic, and in line with the spreads on the standing repo facility and the FEMA repo facility. So one thing I just wanted to note is that with respect to offshore dollar funding markets, our foreign central bank counterparts, at the Bank of Japan, at the ECB, the Bank of England, the Swiss National Bank, they hold auctions each week to supply dollar funding. So, should their respective counterparties or the customers of those counterparties need dollar liquidity, that liquidity is available in those weekly auctions. And I think that's an important feature of this standing backstop tool for global dollar funding. And it's a tool that the Fed and our central bank counterparts have adapted historically by adjusting either the frequency or the maturity of those operations when conditions warrant. So again, we've seen a lot of volatility and a decline in liquidity, but I think markets are functioning in an orderly way, and I do think that the reserves in the system and the more robust policy implementation framework has provided a really strong environment that's reduced precautionary demand for liquidity and supported financial stability in recent days.
Thanks. So going back to a couple of years ago or over the past couple of years, in response to the pandemic shock, obviously the Fed, in addition to making large-scale asset purchases, established a number of other facilities which have been widely discussed. For example, those for corporate bonds and money market funds and so on. How did you think about coordinating those facilities with the LSAPs?
Well, if we go back, to where we were 2 years ago in March and April, the financial disruptions that we were seeing from the pandemic, were significant and they were broad-based. And I think from our previous experience with financial crises, I think we learned that in such circumstances, the policy response, should be swift. It should be sizable and comprehensible. So while the asset purchases of treasuries and MBS that I talked about, I think were effective at addressing the dysfunction in those particular markets. The strains that we were seeing across funding and credit markets did require additional, more targeted tools. And I think it was this comprehensive set of actions that came in quick succession that ultimately addressed the dysfunction across markets and restored market confidence. I'd note that many of the tools used during the global financial crisis were revived during the pandemic, and I think with good results. But we also developed new approaches and tools, both as results of lessons that we had learned previously, but also to address the unique circumstances of the pandemic. And most of the tools, put in place were positioned as backstops. In terms of their pricing. Their pricing was at backstop rates, so they were only attractive for counterparties to access when markets were strained. And so in that case, there was little need, I think, to actively calibrate those tools alongside the asset purchases that we were doing in treasuries and MBS. But that said, in other cases, like the corporate credit facility that you highlighted, in that case, we did use metrics to assess market functioning, and the purchase sizes and the sectors were calibrated according to those metrics. So the approach was quite similar to the one that I talked about today in my remarks for the market functioning purchases of treasuries and agency MBS. So overall, I think the Fed's response to the market dysfunction, it was swift. And it was comprehensive, and it really employed a broad set of tools across a range of markets. Many of those new tools and facilities were structured with backstop rates, so no calibration was necessary with the Treasury and MBS purchases. But there were other active operations like the corporate credit facility, and in that case, we used metrics and processes that were very similar to the ones that we were taking with the Treasury and agency MBS purchases.
That's really helpful. And the backstop role, for those facilities is really a critical one. So a related question, and as you mentioned, and the FOMC has stated explicitly, the LSAPs have at least two distinctive related roles. And the first is to address the strains in markets and support their smooth functioning. And the second is to foster effective transmission of monetary policy to financial conditions. So when we think about balance sheet normalization, how should we distinguish, or should we distinguish, between those two in that context?
Yeah, I mean, I think as I noted in my remarks, the asset purchases were initially conducted to support, market functioning. But later that objective certainly expanded to also fostering accommodative financial conditions. So when I think about how they work, at first, the purchases worked primarily through flow effects to reduce risk premia associated with the strains that we were seeing. But the accumulated securities holdings that, that came about as we purchased, they also fostered accommodative financial conditions. But once purchased and held in the SOMA portfolio, there really isn't, as you note, a clear distinction between, the holdings that we bought for market functioning and the holdings that we bought to provide accommodation. They both reduce the private sector holdings of that interest rate risk. So as I look ahead and think about how, the reduction in SOMA holdings might influence financial conditions, I go back to some of the key channels for how I think the asset purchases, how they worked. The first that we talked about, through the portfolio balance effects, I think the effects, through this channel are probably fairly symmetrical between asset purchases and, balance sheet runoff, with the expectations, for a reduction of our portfolio, increasing the expected stock of privately held debt. And we see in our surveys, that there's, been a significant decline in the SOMA holdings that's expected. And we've seen a commensurate shift in yields in recent months. So I think a reduction in holdings is probably already priced into asset markets. Nonetheless, as the plans for balance sheet reduction come into sharper focus and Treasury's debt issuance approach evolves, we could see additional adjustments in yields, through this portfolio balance channel. The second channel I think about is a signaling one. Balance sheet communications are sometimes viewed by market participants as providing signals about the policy stance and can influence expectations for policy rates. And I guess here, I think the effects can be symmetric and apply to communications about asset purchases and balance sheet reduction similarly. Here, I think the committee's aim to provide clear communications about its approach to balance sheet reduction. So I think that should limit the potential for large surprises in this regard and through this channel. And finally, I think asset purchases and balance sheet reduction can both have flow effects. But in this channel, I think the effects between purchases and runoff as being more asymmetric. Some of the research suggests that flow effects are greatest when markets are stressed, which is why asset purchases work so well to address market dysfunction. Balance sheet reduction, however, is likely to be taking place in environments where markets are functioning well. And so if the process is predictable and conducted over time, I think the flow effects should not be that significant. So overall, my sense is that the reduction in holdings will go smoothly. Market participants already anticipate a somewhat faster pace of reduction than during the prior balance sheet normalization period. So when the committee, assesses its time to begin, we'll be monitoring markets closely and importantly, as we talked about with respect to the principles, they note that the committee is prepared to adjust its approach should economic and financial conditions warrant.
Great. And my last question relates to the standing repo facility. We all think that is designed to promote operational stability in the context of implementing monetary policy. But what about its role for balance sheet normalization? How could the standing repo facility more broadly be made a little more attractive? It's my understanding that very few commercial banks have signed up for it. Is there any stigma attached to it at this point? What could you do to address that? And would relief on the supplementary leverage ratio help to make it a better backstop?
I think, Dick, you asked a more than one last question in there. There's certainly
all related.
A lot to tackle there. I think that the SRF was a really important new tool for the policy framework, serving as a key backstop for money markets. Given the uncertainty and the level of reserves needed to maintain ample conditions, I think having that backstop in money markets to address unexpected pressures will enhance confidence in our ability to control short-term interest rates, particularly in the context of the balance sheet reduction. Okay, so there were a few parts of your question. I think the first one was related to stigma, and some have asked whether the standing repo facility will become stigmatized. I really see no reason that the use of the SRF should be stigmatized. For decades, the desk has used repo to help implement monetary policy, and those operations have not been stigmatized. And in fact, desk repo operations that we conducted in September 2019 and then in March 2020 were widely used by our counterparties and I think highly effective at reducing pressures in money markets. And we didn't hear those type of concerns during either of those two episodes. I think there are also a couple of other features of the standing repo facility in particular that I think help limit the potential for stigma. The standing repo facility is conducted against really high quality liquid collateral, so it's not providing much of a liquidity upgrade for firms accessing the facility. They already have liquid collateral, so I don't think those type of concerns that might emanate from using it would really create those type of issues related to stigma. And also, I think an important component is that the standing repo facility is a daily auction with all counterparties, which should be an attractive option when rates in the market are elevated. And so I think that also would mitigate those concerns. So overall, with respect to stigma, I'm confident that our counterparties will use it when it's attractive to do so. In terms of banks, as you note, banks recently became eligible to be counterparties of the standing repo facility, and that comes in addition to the primary dealers. And as we anticipated, some banks, feel that having access to a repo facility, really makes sense for their business model. But for others, the discount window has been viewed as a more attractive means for the backstop liquidity that's needed for their business model. So far we've had 4 banks sign up, and a number of banks have expressed interest in becoming counterparties. I expect more to be announced shortly, but I do think this will be a gradual process. We have learned a little bit about how banks are viewing this from the senior financial officer survey and from conversations we've had with banks. And those that are not expressing interest, really suggested they don't need that additional source of liquidity, either related to their particular business model or because the discount window is viewed as an effective backstop for their funding profile. And I think the last part of your question was really related to the SLR or other changes in counterparties or other adjustments that may be helpful for the facility over time. I think our sense is that we feel our repo operations have already been successful at controlling rates, but the committee's noted it intends to make adjustments over time if that's needed to ensure that it continues to be effective. I think, we recognize that money markets are very dynamic and the infrastructure changes, and so we may need to adapt the tool over time. And if you look back at, previous FOMC minutes when the standing repo facility was discussed, it was noted that, there could be adjustments over time to improve the balance sheet efficiency of this tool for counterparties if needed by thinking about the costs and benefits of a cleared settlement mechanism. So that could be an adjustment, in the future that could be considered if the committee decided that was warranted. I think I captured all parts of your questions, Dick. Did I miss any of them?
Well, I've hogged the microphone here, so let me turn now to some audience questions. There's a question from Leo Chanette about, the sort of the mechanics. How does the Fed go about reducing its balance sheet? You talked about that a little bit. And there's a mention of sales of securities. Would you consider that? And what do you do with the cash proceeds? I think you covered most of that, but if you want to add to anything there.
I think I talked a bit in the speech about the mechanics and how we approached that during the previous normalization period. And I think the caps were an important feature of that process. In terms of the second part of that question, and would there be considerations for potentially selling securities? Here I think, the principles that the committee issued at the January meeting, really communicated at a high level the planned approach for balance sheet reduction. The principles indicated that the committee intends to reduce those securities holdings over time in a predictable manner and primarily through adjustments to reinvestments, like the process that I talked about from the previous normalization period. And the principles noted that in the longer run, it intends to hold primarily Treasury securities. At the January meeting, many participants commented that sales of agency MBS or reinvesting some portion of principal payments from agency MBS into Treasuries could be appropriate at some point to enable more progress toward a primarily Treasury portfolio in the longer run. But I would anticipate that decisions about the longer run composition of agency MBS would be the ones made by the committee over time with that longer term goal in mind.
Sure. So Darrell Duffy has a question that's kind of related to mine. At a recent Bank Policy Institute meeting, it was mentioned that purchases to improve market functioning could be conducted on behalf of the Treasury, distinguishing them from monetary policy operations by the Fed. Might this be an effective approach, or there are other ways to address this distinction?
I mean, I think, in theory, if we went back to March and April, we were seeing broad-based selling of off-the-run securities, and where there was more activity in the on-the-runs. And I guess you could imagine that the Treasury could have some sort of program where it was swapping on the runs and off the runs in an environment like that. But I think Treasury's primary objectives are to issue debt at the lowest cost for the taxpayers over time. And I think considering a program like that would be pretty complex for Treasury in the context of its other goals. I certainly can't speak for Treasury about whether that would work or not, but I do think in theory, the idea of that concept would have supported market functioning during March and April of last year. But I also think it would be fairly complex for Treasury to think about given their other priorities.
So Jeffrey Herzog asks, the Fed has rolled over maturing holdings at auction and proportionally to what was on tap at auction. Would the Fed ever decide not to do so when rolling over maturing holdings, namely pick and choose what you want to reinvest in?
I think, we've had a process for rolling over maturities that's been in place for decades, I think, for a very long time. I think that process works well. I think it also is in line with our broader implementation objectives that unless we get direction otherwise from the committee to achieve some other policy goal, that we think about our purchases or our rollovers in a very neutral way relative to the debt outstanding. And I think doing so proportionally supports that goal. So I imagine that process is one that we'll continue to rely upon unless the committee gives us other directions for another policy objective of structuring the portfolio in a particular way to meet that policy objective. Without that, I think our intention would be to follow our longstanding practices of being neutral.
Yeah. So questions about the appropriate level LCO, LOR, as people refer to it, the level of reserves consistent with the floor system and effective and efficient operational procedures. Will it be higher or lower than the approximately $1.5 trillion level seen in September of 2019? If it's likely the same or lower, does the Fed do you think that the SRF will be the key factor driving it lower in spite of its uneconomic rate level? If it's likely higher, is it that banks have grown into their larger balance sheets, or that higher outflow assumptions drive higher reserve demand? Related questions.
As we I talked about earlier, the underlying demand for reserves is uncertain and can vary over time. I think from our outreach to banks, they've been focused on managing their balance sheets in the context of the significant amount of reserves that we've put in the system. So I think, they haven't yet started thinking about, where they want their balance sheets and their liquidity management to be, in a future environment when the amount of reserves in the system are quite different. I think it's possible that the experience of the pandemic may have influenced the way some banks think about their liquidity profiles. Maybe there were lessons learned during those early days. And it's also possible that, thinking about supervisory or regulatory guidance with respect to how do you treat the discount window or the standing repo facility in the context of their liquidity management planning may have also influenced the way they think about their lowest comfortable level of reserves in the longer run. So I think it's unclear at this point, and I think that's something we'll be learning and in coming months as banks start to think about the environment as reserves start to decline. Should the committee begin to address balance sheet reduction? I do think our prior experience with balance sheet reduction does help us think about the demand for reserves and estimating it and provide a pretty good guide for the money market indicators that we're really looking for to reflect an ample reserves condition. But of course, we'll be continuing to monitor these conditions as reserves fall, and that'll help us assess the appropriate level of reserves, in the longer run. I do want to note something on the standing repo facility, which is in place now as a backstop. I think it's a really important tool, as I talked about earlier. I think it's there if overnight markets unexpectedly have a shock or unexpected pressures emerge, and it'll keep those pressures from spilling back over into the Fed funds rate and other money market rates. But I do think it's there for unexpected shocks. I don't think we would expect it to be used. I think, if we think about the money market conditions that reflect ample, I think we learned that those money market conditions were stable when rates were, the Fed funds rate was just below IORB. And when rates got too close to IORB or above it, those conditions started to change. Banks started to bid for reserves and conditions became more vulnerable to payment shocks. So, in that environment, I just wouldn't expect there to be, if we have rates just below or close to IORB, wouldn't expect there to be regular standing repo facility use. I really think it's meant to be a backstop for the unexpected.
Got it. So a question from Ray Stone. Are you concerned with the likelihood of a faster liftoff of the funds rate, the interest on reserves? With relatively low rates on the Soma portfolio, are you at all concerned about the risk of negative interest income and fewer remittances to the Treasury in this context?
The FOMC, the FOMC's goals are maximum employment and price stability, and it directs us to manage the portfolio to achieve those goals. So, unrealized gains or losses on the portfolio really have no effect on the ability of the Fed to pursue those two policy goals. It does not affect the Fed's earnings remittances to the U.S. Treasury. Should the committee decide at some point in the future to sell securities, that could create potential to realize some of those losses, which could result in somewhat reduced remittances to the Treasury in the short run. However, the income being generated by the portfolio is quite large, and modest sales program would be unlikely to have a meaningful impact on these remittances. So, I think the key point here is that the committee's goals are maximum employment and price stability, and it manages the portfolio to achieve those objectives.
So a question from Stephen Klein. First, thanks for speaking with us. He's surprised to see you acknowledge the disruption and international pressures created by what's going on in Russia and the Ukraine. However, the Fed is choosing to conclude asset purchases and increase the federal funds rate this month. Why not wait until after the situation resolves? Is waiting 1 month not the prudent and kind decision to make? He's concerned as tightening U.S. policy is often associated with pressures in emerging markets.
I think that's a good question. I think that one's, one that the chair addressed in testimony today. And I think, one that I would turn to policymakers for, on the desk, our focus is really on monitoring financial market developments and supporting the FOMC's policy decisions, with our assessment of market conditions and the market intelligence that we're gathering, and on preparing, for policy implementation to be effective based on the directives that they give us. So, my focus is on financial markets and policy implementation.
Kim Shonels asks, to what extent are yield premium and Treasury bonds currently depressed by the Fed's holdings? In other words, how large is the portfolio balance effect based on your thinking?
As I talked about, I think the asset purchases conducted over the past 2 years have had a meaningful impact on term premiums and have had a meaningful impact on financial conditions. I think there's a lot of uncertainty about the specific measurement of that, but I think the direction of it and that it's been meaningful, I think has been pretty consistent finding across our analysis and research that we've been reading. So I think it, I don't have an exact number, I would say, because I think things are more uncertain than that, but I do think it's been quite meaningful.
Right. There are a bunch of other questions related to policy, and since you execute rather than make policy, I'm not going to ask those. But one relates to the size of the balance sheet from Teja Munkala. Is there an eventual target for balance sheet in terms of size? Will you use securities sales to get there? And secondly, some of the other central banks have indicated on providing more support in terms of cash purchases in light of what's going on in Russia and Ukraine. How does that factor into decision-making the balance sheet runoff if the situation worsens?
In terms of the size of the balance sheet, the principles stated that over time, the committee intends to maintain holdings and amounts needed to implement policy efficiently and effectively in an ample reserves regime. So the size of the balance sheet's really going to be driven by the demand for the Fed's liabilities. I think we're a significant ways away from where that level is today. But I think the important point is that over the last 2 years, the portfolio's been growing and been motivated by the asset side. And I think as we look to reduce the balance sheet, that's going to be guided by the liability side of the balance sheet.
Yep.
And will really be determined by the demand for those liabilities and ensuring that we maintain reserves in the system so that money market conditions represent an ample framework.
Great. And we have time for one more, and that is related to the spread between RRP and IORB. Do you expect the spread, this is from Chris Walsh, do do you expect that spread to move back to the historical norm of around 25 basis points as the effective Fed funds rate moves higher?
My focus right now is on, preparing for the committee to lift the target range off the zero lower bound. And I think in this environment that we're in right now, I think the setting of IORB and the overnight RRP within the target range is supporting the effective Fed funds rate trading, well within the target range. And I expect that this setting of administered rates in the context of the target range will be appropriate as the committee lifts the target range off of the zero lower bound. I think over time, we'll have to see how money market conditions evolve. And we'll be monitoring those conditions, and we'll make adjustments if they're warranted. But that's not where the focus is right now. And right now, I think the settings are proving well at achieving our objective of keeping the Fed funds rate well within the target range.
So, Lorie, I want to thank you so much for taking the time to talk to us today. I think this has been really, an important topic and helps us and market participants understand how the Fed's doing its job, how you're doing your job. And the communication we've had today, I think, between the people who are listening and you has been just really, really informative and great. And I want to thank everybody who participated in this for coming. Thank my colleague Venki for co-sponsoring this. And thanks to everybody who asked questions. And that's going to conclude our presentation. Thank you again, Lorie. It's been great.
Thank you, Dick, and thanks, Venki, and thanks for all the great questions today. I really, really enjoyed being here and the discussion.
Great. Thank you.